Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to this week's Top Stock Picks of the Week. I'm Tracy Brynick, and I'm joined this week by Ben Rains, and we're bringing you a couple of course, Zacks #1 strong buys. These are our top picks, but where are they this year with all the estimates being cut? Who is seeing their estimates being increased right now? That takes a special stock. And I know with my stock, they recently just reported, had another earnings beat, and they raised for the full year. A beat and the raise, that's pretty strong. What is my company? It's e.l.f. Beauty. Yes, the beauty area is very popular right now. Ticker e.l.f. You can't miss that one. And it's been popular since the reopening when we stopped wearing masks. A lot of women went back to their beauty regimes, including skincare, which e.l.f. also sells. So what is going on with this company? How is it this good? Let's take a look at the earnings estimates and see. So e.l.f. Beauty just recently reported at the early part of February here, and you can see the analysts are bullish. This is their fiscal 2023. It was their third quarter, so they're only with one more quarter here to go. But the analysts on the raise had a raise here, so we get the earnings increase there, and that's going to give us earnings up 61% this year versus last year. But then look at fiscal 2024. Analysts think they're going to continue to have this kind of bullish momentum. You have 9 earnings estimates increased for that year on that far right column there, and that's another 11% earnings growth. And that's before we're even into that fiscal year. So that all looks good. But what does it look like on the chart, this kind of earnings growth? This is the chart. So you do want to see the earnings going up and to the right, and that is what we saw. We see it there in 2022. We're seeing it in the 2023, and with the raise, they've raised several times this year in fiscal 2023. And then you see the analysts getting very bullish on 2024. That's that tannish brown line going up. But you can also tell that the shares have surged in the last year, and you can see it even better on the earnings surprise chart. They only have that one miss back in 2021, and then they're putting together this string of incredibly big earnings surprises. So even though they're raising guidance multiple times, the analysts are still behind. Even last quarter, for the third quarter, they beat 48 cents versus 23 cents. So the analysts are just really underestimating the strength of the beauty market right now, and that the consumer is really spending on these types of products. But again, look at that chart. It started taking off in mid-2022, and it really hasn't stopped. It's at these new 5-year highs. And over those 5 years, the shares are up 173%. That's versus the S&P 500 up just 57%. So this is one of the rare stocks that is now handily beating the S&P 500 over the longer extended period. Over the last year, it's easily beating it as well, up 144% on this surge in the shares. But what is happening with valuations? This is my only downside, my only negative about e.l.f. right now, but I'm the value investor, so I'm always looking for value. And while I like the beauty area, and this one does have growth, obviously, it is growing earnings at double digits, it's still trading at 50 times those forward earnings. So that's a little pricey for me, but I still like the overall story. I like it going into 2024. As one of my colleagues, Dave Bartosiak, always says, once it has momentum, the stock usually continues to have momentum. So you got to like that as a trader, especially. But as a longer term investor, I would probably still be on the sidelines here, even with the #1 ranked strong buy recommendation, and waiting for some kind of pullback, something to weaken these shares, even just, 10% or 20% possibly. Anything I would take. So I would still be waiting a little bit on the sidelines for it to cool a bit, because ultimately it will cool, and then you're going to get in at a better valuation. But e.l.f. still got that momentum. You can't dispute that it keeps beating and it keeps raising the guidance, and very few companies are doing that here in 2023. So my number one is pretty red hot. Is Ben's number one going to be red hot? I'm throwing it over to him so we can find out.
Hello, everybody. Ben Rains here. Today, I'm taking a look at NRG Energy, which trades in the ticker NRG. So just like its name, NRG is a utility powerhouse that generates electricity and provides energy solutions and natural gas to millions of businesses and residential customers. The Houston-based company is now poised to roll out more digital-focused efforts as electric grids, homes, and businesses grow more tech-heavy by the day. NRG announced a big splash to help expand almost overnight into much more than a utility firm. So in early December, the company said it agreed to buy Vivint Smart Homes for about $2.8 billion in an all-cash deal. NRG sees the purchase as a fantastic way to establish itself as a, quote, leading provider of essential home services. So the deal is projected to close at some point in the first quarter of 2023, and the newly beefed up and diversified NRG will boast a network of about 7.4 million customers across North America, with it likely to incorporate the company's new back-end tech ecosystem kind of across all of NRG. The company will also be able to bundle its utilities, home security, automation, and much more. NRG sees the acquisition as helping it prepare for a totally connected future as it brings in a company and its tech that already lives inside people's homes. So it's preparing for a world where homes and businesses are seamlessly managed and optimized energy storage, electric vehicle charging, and beyond. The deal also creates a little bit more predictability and stability for NRG because of Vivint's subscription-based model. Wall Street did, however, show its displeasure with NRG for seemingly, stepping out of its lane. So the post agreement announcement sell-off has it trading about 27% below its highs. So it's trading at around $34.50 per share. NRG currently trades 10% also below the current average Zacks price target. And then in terms of valuation, it's looking really juicy at the moment. So NRG is trading at a 55% discount to its industry at just 6.4 times forward earnings and 45% below its own 10-year median. The company's dividend yield is currently 4.4% to really easily crush its industry's 3.1% average, and it has a very sustainable payout ratio of about 23%. The company also plans to complete the remaining part of its $1 billion buyback program over the near term. So it had about $360 million of that remaining at the end of last quarter. NRG also said that our estimates for NRG, so the Zacks estimates are calling for its revenue to soar 20% this year to help lift its adjusted earnings by another 46%. And then its bottom line positivity, especially for 2023, which is trending heavily in the right direction, has it landing at a Zacks ranked number one strong buy at the moment. So that does it for this episode of Top Stock Picks. Make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more.